Welcome you to doing the income statement. We're going to do a sample company today. It's called Try Harder Company, and that's the name of the company. And you also need the name of the statement on there, which is the income statement, and then the time period that we're talking about. And this is for the year ended December 31st. The most common time periods is for the month ended, for the quarter ended, or for the year ended. So you do need a time period on there. And this will be a classified income statement, not a single step. It's a multi-step income statement, actually. So the first thing we have on here is the revenues. Now, revenues are made up of sales. Okay, so in the sales, you can have various sales. We're going to make it $789,500 in our example. But sales can be made up of, you can break it down into various aspects of sales, such as men's clothing, appliances, women's clothing, shoes. You can break it down as fine as you want to. You can break it down by sizes if you want. However, keep in mind, the farther you break it down, the more it's going to cost to gather that information. So you really find out, is it worth is the breakdown worth the extra cost? And if it is, then you break it down. If it isn't, just leave it as sales. Okay. After sales, we have sales discounts, which is $1,500 in our example. And then we're also going to have sales returns and allowances, which is right here, which is for, in this example, is going to be $600. So then we would add those together, which would be the $1,500 plus the $600. That gives us our total deductions that we take from sales. So we take $789,500 minus the $2,100 to get $787,400, and this is called net sales. Then after net sales, the next section will be the cost of goods sold section. So we do the cost of goods sold, and that's made up of your beginning inventory. So it's inventory as of January 1st, and that is for $26,000. You notice I have a 1, 2, 3, 4 column, and this is in the third column. You work your way over. Then after purchase, beginning inventory, we have purchases, which is right here. Purchases is going to amount to $289,500. And then from purchases, just like sales, we can take off purchase returns, purchase discounts. So we subtract off purchase discounts, which will go in the first column of $800. And then we also subtract off purchase returns and allowances, which is for $950 in this case. And then we add the purchase discounts and the purchase returns allowances. So we have $800 plus the $950. And then that will give us our net purchases. We subtract those. So we take $289,500 minus the $1,750 to get $287,750 for net purchases. But we're not done yet, because we also may have freight in. We have to pay for the transportation to come in. So we add freight in, which in this case is $7,800. So then we add those two together, which is $287,750 plus the $7,800 to get $295,550. We then, that's my cost of goods purchased, really. And then we add that to the $295,550 plus the $26,000 to come up with $321,550, and that is my goods available for sale, which is okay. Then if we take off ending inventory, so inventory December 31st, which I made $19,800, subtract that, so we take $321,550 minus the $19,800 to get $301,750, and this is my cost of goods sold. Okay, and then after we have the cost of goods sold, we have our gross profit by taking our net sales of $787,400 minus the cost of goods sold of $301,750 to come up with $485,650. Okay, so that's that section. This is a periodic inventory system. That's why you have the cost of goods sold. Sometimes this section right here is actually a separate schedule that you may put together called the cost of goods sold schedule, in which case then you'd only have one line here called cost of goods sold, and that would be for the $301,750. Okay, that's another option you can do, is you make that as a separate schedule, so it's not part of the income statement and doesn't make the income statement so long. After gross profit, we then start with the operating expenses. Okay, that's our next section. Now, there are two types of operating expenses. There are selling expenses, which is what we do first, and of course then there's general administrative expenses. Selling expenses are those expenses that relate into selling of the product. So the first one we have here, of course the most obvious one, is advertising. Advertising, we make $67.50, and we're not even going to try to list all of them. I'm just going to give you a couple examples. We also have sales salaries expense, because that's for the salesman, salesperson, whatever you want to call them, $35,800. And then we also have then the good old catch-all phrase, miscellaneous selling expenses of $15.80. We then add those together. So we take the $67.50 plus $35,800 plus the $15.80 to come up with $44,130. Like I said, I'm not even going to try to list all the selling expenses. There's a lot more that go in there, but that's good enough for right now. The other ones you have then after selling expenses is general administrative expenses, and that's the expenses that are basically office related, that don't really involve directly in selling the product, but that's not saying they're not necessary. That would be the officer salary expense would be an example, and that's for $48,950. We have office supplies expense, and that one is going to be $12,400. Then we'll have depreciation expense on office building, and that's for $28,600. We have depreciation expense office furniture and fixtures, which is for $18,500. We have your bad debt expense, which is for $68.75. We have insurance expense, and again, this is not by any means an exhaustive list, but gives you an idea. After insurance, $18,900 for that one. Property tax expense, which I'll have in here as $27,800. And then of course the last one, always the last one, is the miscellaneous general expenses, which will be for $68.90. Now, then you add all those up. So all the way from the $48,900 plus the $12,400 plus $28,600, $18,500, $68.75, $18,900, $27,800, and $68.90 for a total of $168,915. Then you add the two expenses together, the $44,130 plus the $168,915 to get $213,045, and that total is equal to let's see, where's it at? The total operating expenses. There we go. And then you'll take the total operating expenses and subtract it. No, yeah. And subtract it from your gross profit, which would be then the 485,650 minus 213,045 to get the 272,605, and that is your operating income. Okay. Hopefully this section is a quick review of what you've already done, maybe a little bit more expanded. Now sometimes depreciation is a separate section, that they have a third section. They have general administrative expenses, and then they have a depreciation section. Either way is fine. It's basically is what you do, what the instructor wants. We now have, after operating income, other revenues and gains, which is another section. Now this is income that you have coming in, but it's not your normal sales. Okay, so this would be other items that you may have, such as if you have investments in other companies, you have dividend revenue, which in my case is $29,500. That's having common stock that you purchase in another company. You could also have interest revenue, and that would be notes receivables that you may have with somebody, or CDs, or that type of thing. And you also have any gain on the sale of assets in here. In this case, I have gain on sale of land, and that one is for $29,500. You add these together, so you have the 29. I'm going to use the same number, 29,500. Backspace. 29,500 plus the 16,850 plus the 29,500 again for 75,850. So that's my total other revenue. Again, other revenues and gains is things that you earned income off of or made a gain off of that's not your normal course of business. So on the same line as other gains and revenues, we also have other expenses and losses. And again, this is the same type of thing. It's not your normal course of business. So what we have in that one would be, a most common one would be interest expense, which most of us are real familiar with that one. That one is for $31,200. Then we have also loss on sale of assets, which is, there it is, loss on sale of assets. This would be loss on sale of equipment, whatever you may have, $16,200. And then I put another one in here called loss from fire. You don't have that every day, but that also goes into the other expense category because it can happen. And that's going to be for $35,000. We then add those up, so we have $31,200 plus $16,200 plus $35,000 for a total of $82,400. We then add those to subtract them, so we take $75,850 minus $82,400. So our other revenues and gains, actually it's the other losses and expenses exceed, so it's a negative number of $65,550. We then add that to the $272,605 plus the negative $550 to come up with $266,050. And the $266,050 is my income from continuing operations before taxes. And then we do the income tax. Where's my income tax? There we go, income tax. And we're assuming a 30% rate on that. So we take the $266,055 times the 0.30 and get $79,018. And that will give me then income from continuing operations of, we subtract those two, the $266,055 minus the $79,817 to get $186,239. And that concludes this part of it. That's review, and I'll continue on with the next video.